Thank you for joining us for the third video of the Financial Foundation course. Today, we're going to start digging into income and expenses. So we're going to start describing a little bit of differences within the income as well as differences that you'll find in the expenses, because we need to understand how both the income works and the expenses work, so we know what's coming in, what's going out, why it's going in, why it's going out, when is it going out. All those sorts of things helps us sort of capture sort of our financial picture, and then develops tactics for us to either grow income or reduce expenses. And so we need to understand these things before we can begin that process, in which we'll dig deeper in on the budgeting video. So I can't wait to get started. Let's go. All right, let's get into income and expenses. Again, I'm Thinking Cap Financial, Ryan DeRusso. I'm a fee only financial advisor, and I work with private practice owners. So this is what we're going to cover today. We're going to talk about the importance of tracking income and expenses in your personal life as well as your practice, and what you need to properly track income and expenses. The different types of income that you should track, because it's not all the same, especially since you are a business owner, and then what insights you can gain by evaluating your income, as well as what type of expenses there are and what type of insights you can bring from evaluating those expenses. Let's get started. Before we do, make sure to follow that newsletter, thinkingcapfinancial.com/newsletter. There'll be tips, advice, and those sorts of things in there. You can find me on YouTube as well at Thinking Solo, or on LinkedIn. I'm at Ryan DeRusso, my name. Make sure to share this course. We want to grow together. We want to build wealth together in the private practice space. You do so much good for others, and we want to make sure that you are properly compensated for that good work. And so let's share. Beware, make sure to watch this whole video. It's the most important one right now. And so please watch all the way through so you don't miss anything. And then, of course, I sound a lot smarter at 2 times speed. So feel free to do that. And if you find you miss something, then you can always go back. But I find it just goes a lot faster that way. All right, income and expenses. So what type of income do you have as a private practice owner? You think, hey, my income is just my business. And in fact, that's not totally true, because what's happening is you have the business here, you have the personal here, and the money flows from the business to the personal. So if you have sole proprietorship, you have an LLC, even if you have an S Corp, what it's doing is flowing through to you. And so therefore it's flow through income. It's not a salary. It's not revenue. It's not profits. Instead, it's that flow through income. And it differs in a lot of ways from, say, the W-2 who gets a specific amount of money every 2 weeks. You don't necessarily get that. It can be very up and down in your practice. And so because of that, the dynamics of income is a little different than, say, if you have a partner that has a regular full-time gig. And so because of that, we need to understand sort of the different types of revenues and incomes that we're going to come across. And so first, you see revenue here, and essentially that's every dollar your business makes before expenses. Essentially what we're talking about here is gross revenue. So if you have a session and you charge $200 a session, then that $200 counts as gross revenue. What happens then is you have certain expenses that you accrue because you need those expenses in order to properly see that client. Say it's like $30. Well, now the profits are $200, the revenues, minus $30, the expenses, to create profits of $170. When that flows to you, then it becomes income. But it's not until you have paid yourself from the business that it really becomes income for our purposes. And because many of you operate in a sole proprietorship or an LLC, even if you make it here and you don't pay yourself here, it will still count as income eventually come tax time. That's why it's called a flow-through entity, because you're basically paying taxes through your personal account for the business. Other income that you will find come tax time are, let's say you have a savings account that's earning interest. The interest will count as income. Investments, if those are paying dividends or something like that, or you sold investments or something, then that would count as income. your partner's job. If you have a partner and they have a full-time job, or even if they are self-employed, whatever they're paying themselves in the business, then that would also count as income. Any gifts you receive could count as income, as well as real estate, rents and stuff like that. That would count as income. And then really any other sort of source that's providing you money in some way, it's going to go down on the income line. And your tax calculation essentially starts with whatever that number is in total. And so one thing I would do is encourage you to track on the business side how much revenue is coming in. And then on the personal side, how much income you are actually receiving. Because if you can give yourself a recognition of that, you can then determine what needs to change, or if you need more income from the business, that sort of thing. But it can also give you ideas of sort of how to build income in the future. Let's say you have very little investment income. Maybe that's a place to start. Or the idea of real estate kind of appeals to you, and having that flow to your income line would be valuable. So maybe that's a goal that you have down the line. Recognizing sort of your full income life will help guide your purchasing decisions, your expenses, all that sort of thing. So it's really important to know. Now let's talk about expenses. Variable versus fixed is something that most people have come across. The term fixed is often used. I actually like to use a term called flex, but we'll get to that in another video. But we need to understand the difference between those two, and so we'll get a little further into that. We also want to talk a little bit about monthly versus non-monthly expenses, and then we'll delve into personal versus business expenses. And then, of course, of all things, we want to avoid this last expense, which is the debt spiral. Essentially, what happens there is we have overspent according to our income. And so we're taking out credit cards or other debt tools. And now so much of our income from the practice is going to debt payments. This creates a debt spiral because we can't pay the debt payment because we have other needs. We have to pay rent, we have to buy food, those sorts of things. And so the debt continues to build, and it builds a lot faster than our income does. And so what can happen is the debt can overtake any other expense, and we want to avoid that. But you need to recognize that when you have debt, those monthly payments become an expense, and we want to avoid them overtaking all other expenses. Before we get into sort of the difference between the types of expenses, I want to make sure that we also understand the difference between a liability and expense. So a liability is something you owe, where expense is something that you have spent. So when you have a car loan and you do a monthly car payment, that is an expense, the monthly car payment. However, the full balance of what you owe, that is a liability. And so that's really the difference there. Now, let's say you're going shopping, you're eating at restaurants, you're putting it all on a credit card. As it goes on a credit card, it counts as an expense. If you don't pay off that full credit card at the end of the month, then it becomes a liability because it's something you owe. And it's important to understand the differences between these, because liabilities are long-term, expenses are short-term. We can cut expenses. There's only so much we can do once they become a liability. Within the show or within the video notes, you can make sure to download a longer list of fixed costs versus variable costs. I've included it there, but here are some common ones that we see. And essentially, fixed costs are the ones that come due every month. It's about the same amount every month. And variable or flex costs are the ones that go up and down, and the ones that we may need on a month-to-month basis. We need groceries, we need food on a month-to-month basis, but they can vary greatly depending on what we're spending on and how we're spending it, sort of thing. And so some examples of fixed costs: mortgage, utilities, subscriptions. These are basically the same price every month. Childcare is often the same price per month. Auto payments, internet phones, student loan payments, they may change once a year, but then they become a fixed cost essentially. Same with most insurances. And if you are a member of a gym that bills you monthly, it's probably about the same price every month, so it would fall under the fixed cost. But you can see that some of these are needs and some of these are wants. The gym might be more of a want. The mortgage might be a need, sort of thing. So it doesn't really matter where they are in terms of that need versus want dynamic. It's more about sort of how they come out of your credit card or how they come out of your account every month. Variable costs, groceries, entertainment, restaurant, bars, child activities, taxis, shopping, clothing, coffee shops. All very similar in the sense that they go up, they go down. 1 month we might spend a lot more on groceries. The next month we might spend a lot more on restaurants. And so they just kind of bounce around. We just need to get an understanding of how we typically spend so we can create some sort of balance there on the variable side. Another sort of expenses that we need to manage are the non-monthly costs. So these are the things that come around once, twice, 3 times a year, and we're always surprised by them. And yet we know that they're going to come around every year. And so the more we're sort of planning for these types of expenses, the better off we're going to be. Things like these are the vacations, holiday travel, gifts. Holiday gifts is a big one. Every year around the holidays, we're always like, oh, we have to spend so much on gifts. But if we're planning throughout the year, maybe it's not as big of a burden. Car maintenance, home improvement, veterinary care is another one for pet owners that comes up a lot, as is summer camps for those who with kids. Every year, I'm always surprised by the cost, but if we're managing it correctly, then it's not so much of a headache. Ongoing dental health costs, we're going to see the doctor so many times a year, probably. Hopefully it's not too much, but within reason, we can kind of plan for that. Some utilities and some insurance as well, if they're not billed on a per monthly basis. Business versus non-business expenses is a tricky one because when we have a business, we often write off certain expenses for that business. But some of those expenses are actually personal expenses that we're just able to write off for business. The perfect example of this is rent or mortgage. When you work from your home, then you are able to write off a certain amount of your home expenses based on where you work. And that then becomes a business expense. But it's not really a business expense. It's just a life expense that the IRS is allowing as a business expense. Meanwhile, you're probably paying for that mortgage or rent via your personal account. And so we need to make sure we're accounting for the differences there. In a video in a different course that I'm building, I'm actually going to walk you through this process of how to properly understand what your business expenses are for the year, and then take those business expenses and turn them into lifestyle expenses. And so we take what we make in a year, take away the business expenses, add back in a certain amount of those business expenses, take that away from our revenue, and we come up with lifestyle costs. And it's an equation that I use for many of my clients, but the more accurate we are between personal expenses, business expenses, and personal expenses for the business, the better off we're going to be. As you're looking further into these things, what you're going to start to do is recognize where you can build and where you can cut. What we're going to work on in the next video is really trying to figure out what your needs and your wants are, so we can kind of guide our where we're going to cut and where we're going to build and where we're going to increase expenses and where we're going to decrease expenses. But for now, just understanding the differences between how expenses come out of the account, what will come out. One, it'll give us a better understanding of how to pay ourselves. And then 2, it'll help us figure out ways that we can reduce expenses, especially in the early days when we're building that practice. It'll also give us insight into our income the more we're tracking this on a regular basis, so we can figure out sort of where to invest and grow that income. So, important things to take away from this video. Since it's more educational, it's less action-oriented, just recognize that there are different types of income, there are different types of expenses, and you need to know the difference between the two. The more we're tracking each one, we have a spreadsheet of business income and business expenses, or business revenues and business expenses. We have a spreadsheet or tool, which we'll get to in a future video, tracking personal expenses and personal income. The better off we can create a balance between the personal and the business that allows us to save, allows us to purchase the things that we need and that we want, and allows us to achieve our lifelong goals. Make sure to track this over time. It's just like your net worth. It changes every single time that we're looking at this. And so the more that we're tracking this, the more that we're going to be aware of what's going on and the dynamics at play that's impacting the reason we're feeling like less wealthy or less disposable income or something like that. And then uncover opportunities. As we're digging deeper into these things, we're going to figure out ways that we can either cut or we can either grow. And the more you're looking at this, the more that's going to become clear over time. For more, make sure to join that newsletter, thinkingcapfinancial.com/newsletter. Much more guidance there, much more advice. And in the next video, what we're going to do is take what we've learned here and then start applying it to our specific needs and wants so we can start reducing those things that we don't want or need and increasing the things that we do. And then make sure if, this has been helpful, send a testimonial at thinkingcapfinancial.com/testimonials. There is a clear guidance on how to do so. And if you do, you enter to win a prize. And then let's get started today, and I'll see you in the next video.